Next, practical application of rigid income model, valuing a private equity investment. You can find this material at the same folder. Introduction, RIM for alternative investment. While the residual income model RIM is widely recognized for valuing publicly traded equities, its principles are equally applicable and often highly insightful when valuing alternative investments. Alternative assets such as private equity, real estate, infrastructure, and hedge funds frequently lack readily available market prices. In such cases, intrinsic valuation technique like RIM can be particularly valuable. This document presents a case study demonstrating the practical application of discrete time RIM to value hypothetical private equity PE investment. We walk through the steps, assumptions, and interpretations involved in using RIM for this asset class, highlighting both its strengths and some practical considerations. Now again, brief overview of discrete time rigid income model. In its discrete time form, the intrinsic value of equity at time t equals 0, the present value using the rigid income model is given by V naught equal B naught and the summation of present value of all future rigid income. Here it is important that it starts from B naught. We know book value, it is accounting, right? So we know book value. And possibly this part, yeah, part is small. So well, rigid income model is very robust. If you use net present value, for example, typical textbook net present value model, the valuation is highly sensitive to your assumption about terminal value, right? But here, we move large way to the beginning, which is book value, and we know that. Therefore, it is less sensitive to your assumption. That is actually value of the residual income model. Also, residual income model is highly insightful because we simply discount residual income, which is positive only when a company's business model makes sense. If a company's business model is just so-so, well, it should not beat the market, then residual income is 0. If its business model is not good, then residual income should be actually negative. So by using residual income model, you can apply your insight about the business model of the firm. Well, when you assess the business model of the firm, well, we learn many things in university, right? You can analyze its strategy, its organization, information system, like that. Okay. So well, V naught is intrinsic value of equity at time 0. V naught is book value of equity at time 0. You visually know that. Accountant calculate this. And RI is residual income in period I. RE is cost of equity capital. It is basically discount rate. And N is the number of forecast period. So we assume that this company can generate excess return over the only next N period. This firm enjoy sustainable comparative advantage for the next N period when RI is positive. Of course, if this company enjoys only sustainable comparative disadvantage, then residual income is negative. To remind you, residual income for period I is calculated as RI. I is net income minus cost of equity. Okay, opportunity cost of equity. RE multiplied BI minus 1. Here, NI is net income in period I, BNI minus 1, the book value of equity at the end of the period, previous period, or beginning of period if it is I. Now, book value evolve over time based on this one. Okay, BI equal BI minus 1 plus net income minus DI. So this is retention, amounts of retention. net income minus dividend is amount of retention. By adding retention to your book value, previous book value, you have now present book value, where DI is dividend or distribution in time I, so it includes share buyback, repurchase. For practical application, especially the alternative investment with finite horizons, we typically project residual income for a finite number of periods, like 3 or 5. Unlike many traditional DCF approaches, the RIM does not require separate terminal value. This is important. We don't have to model terminal value because the incremental value is entirely captured by the residual income forecast. Now, case study. Case study valuing a private equity investment in a manufacturing company. Scenario: imagine a private equity firm is evaluating investment in Manufacturing Co., a mid-sized manufacturing company. The PE firm plans to hold the investment for 5 years, actively manage the company to improve performance, and then exit. We will use the residual income model to estimate the intrinsic value of manufacturing cost equity from the PE firm's perspective at the time of the initial investment, year 0. Assumption and projected financial data. Okay, for the purpose of this case study, we make the following assumption and projection for Manufacturing Co. over the next 5 years. Initial book value, we note, is $50 million as for list financial statement. So we know this. This is big advantage of residual income model. We already know large part of the value, which is book value, same to the book value. Now we can only discount only residual part, residual income. Now cost of equity, let's assume cost of equity R is 15%, reflect a higher risk, possibly illiquidity risk. Well, private equity firm, it is hard to exit. Since it is hard to exit, you require higher rate. Discount rate should be higher. You require higher rate. And special risk of private equity investment. And then let's assume projected net income is for the next 5 years 10, 12, 15, 17, 8 million. Now reinvestment rule is that assume that 60% of net income is reinvested in the business while 40% is distributed as a dividend to the private equity firm. Private equity firm take out 40% of net income. Let's assume that. So DI is 0.4 multiplied by net income. It means that retention rate is 60% of net income. Now let's make projected financial table. Based on this assumption, we project the financial table and calculate residual income for the next 5 years. So beginning book value, we know the $50 million, and then we know residual income 10, and we pay out dividend by 4. So by ending, we have 6 retentions, we have 56. Okay, now equity charge, by multiple equity charge 15% to 56, it is 7.5. The residual income is 2.5 million. Okay, now we start from the now beginning book value 56. Now net income is 12. Dividend, well, we pay out dividend 40%, so 4.8. Ending balance, by adding the retention, then we have 63. Equity charge, by multiple 15%, we have this one. We keep doing this. Okay, now we are ready to do the residual income valuation. We now calculate the intrinsic value of the manufacturing cost equity using RIM and the projected data. Okay, so present value of residual income, PV of RI. Each year's residual income is discounted back to year 0 using the cost of equity. So year 1 is 0.5, like 2.5 million. Well, we have this number, right? Residual income, the last column, we divide this one with, actually multiply this one discount factor, which increases over time, and discount rate is 15%. So we have like this one. Now, total present value of residual income is therefore about $14.9 million. Now, intrinsic valuation is we can simply add back the book value without adding a separate terminal value component. That's a big advantage. The intrinsic value at time 0 is calculated by summing the initial book value and the present value of the residual income over the forecast horizon. Okay, substituting the numbers now, the value of this company that private equity is interested in is $64.9 million. Thus, according to the RIM valuation, the estimated intrinsic value of manufacturing cost equity is approximately $64.9 million. Now, interpretation and the practical consideration for alternative investment. Valuation interpretation. Okay, in this RIM valuation, manufacturing cost intrinsic equity value is estimated at 64.9 million, which is higher than the initial book value, which is 50 million. Okay, the difference is 40.9 million, represents the present value of the expected future residual income. This company can generate positive expected future residual income because it has some possibly comparative advantage over its competitor over the market. Therefore, it can generate excess return over the cost of equity during the 5 forecast period. For the PE firm, acquiring manufacturing cost at price well below this value, 64.9 million, could provide a margin of safety and an opportunity for significant value creation. So this private equity firm should acquire this company below this number, right? Now, practical consideration for RIM in alternative investment. When applying RIM to alternative investment such as private equity, several nuances merit careful consideration. Data reliability and projection. Financial projections for private companies are inherently uncertain. Rigorous due diligence, stress testing, and sensitive analysis key assumptions such as growth rate, ROA, and cost of equity are crucial. Cost of equity for alternatives. Determining the appropriate RE is challenging for private investment. The cost of equity should reflect higher risk and illiquidity compared to public companies. It is difficult to exit. It is harder to sell once you invest, right? That's illiquidity risk. Adjustment to model like CAPM or alternative methods like build-up approach may be necessary. Terminal value considered. In RIM, the value of future excess return is captured directly by residual income forecast. A separate terminal value is not required because any residual value beyond the forecast horizon is implicitly embedded in the progressive book value. Okay, we simply assume 0. Residual income is 0 after the terminal period. Book value consideration. In private equity, the book value can be affected by accounting policies and fair value adjustment post-acquisition. It is important to assess the quality and reliability of the reported book value. You have to check accountant. Liquidity and marketability discount. Given the illiquid nature of many alternative investment, a discount for lack of marketability or liquidity may be warranted when moving from an intrinsic valuation to transaction price. Now, sensitivity analysis and limitation. Sensitivity analysis. Okay. Given the uncertainty in key value, it is advisable to perform sensitive analysis. For example, cost of equity variation or a higher ROE will lead to present value of future residual income. We can check how much it is sensitive. How much change in net income projection. Adjustment in projected net income or dividend payout ratio will directly impact the residual income calculation and the valuation. Limitation. While the RIM provides a robust framework for valuation, certain limitations should be noted. Again, it relies on projection. The model is sensitive to the quality of forecast financial. Inaccurate projection can lead to misvaluation. Now, accounting policy variability. Differences in accounting practices may distort the book value, making comparability of the firm difficult. Conclusion. This case demonstrates the practical applicability of the residual income model for valuing a private equity investment. Despite inherent challenges such as projecting financial for private companies and determining an appropriate cost of equity, RM offers a conceptual sound framework for estimating intrinsic value. By only focusing on future intrinsic income generation and book value evolution, the model enables investors to assess the potential economic value creation beyond what current earning or book value might suggest. That is the big advantage over textbook valuation model like NPV. Okay, because we highlight, we can, by using this framework, we can highlight future residual income generation, potential economic value creation. We can directly assess whether a particular company has the potential for value creation or not. Then we have to check its business model. For practitioners, a combination of robust financial projection, sensitivity analysis, and a careful consideration of the unique characteristic of alternative investment is essential to perform a meaningful RIM valuation. Ultimately, integrated RIM with other valuation methods and qualitative assessment can provide a more comprehensive view of the investment potential. Next, simple example of continuous time RIM application. To illustrate the continuous time residual income model, consider a simplified scenario where we value a company at time t equals 0 with the following characteristic. Current book value is $100, return on equity 12%, let's assume it constant, cost of equity 10%, assumed constant, dividend payout ratio 50%, and excess return. This project can generate excess return and has a sustainable competitive advantage only for the next 10 years. In this framework, only a portion of net income is retained to grow the book value, with the growth rate given by G is 1 minus K ROE, which is 6%. Also compute G minus RE is 6% minus 10% is about 4%. Okay, since G is less than RE, the term GRE is negative, which is common when excess returns are modest. Okay. Now we can calculate exponential term calculation, which is this one, and then present value of residual income is this part. Okay, this part, and then surrender value is this one. Okay, in the formula, so 16.485. Total interest value by adding them is 116.49. The interpretation is that this example demonstrates a continuous time residual income model. Starting with a book value of $100, the company is valued at about 116.19 because it is expected to generate excess return. Since ROE is greater than RE, this company is capable of creating value over opportunity cost of capital over the next 10 years. Okay, this 16.49 contribution from residual income captures the value created from earning a return above the cost of equity.